Hi, Patrick Russell, EA, with today's Caliente topic. What's a Section 1031 exchange? The Internal Revenue Code Section 1031 like-kind exchange is an immensely popular tax incentive enjoyed by many savvy real estate investors since its enactment back in 1954. If applied correctly, the Section 1031 allows for investors to build up their asset portfolio by exchanging existing business or investment properties for higher valued business or investment properties without paying any taxes on the gain. How? By selling your currently owned business or investment property and reinvesting the proceeds into purchasing a more valuable, like-kind business or investment property. What type of property, Pat? A business or investment property. The classic case involves real estate, rental property. Selling a single-family residence for a larger multi-unit residential rental property, that's where you see most Section 1031s applied, with a huge caveat. The various loopholes inherited in this code, both in its definition of like-kind and in what is a business or investment property, is way beyond just one Caliente topic. Suffice to say, there's plenty of wiggle room depending on all the circumstances that even vacation homes and residences can qualify. Coming back around to the basics, here is how the Section 1031 works. To start, two new terms to know: relinquished property and replacement property. A relinquished property is the property that you currently own that you're planning on selling or relinquishing, aka giving up. The replacement property, that's the property that you want to buy that will replace the relinquished property. Okay, what matters most is meeting deadlines. You have two major ones. They're both triggered upon the sale of your original property, that relinquished property. The first deadline is a property owner has 45 days from the closing date on the sale of that first property to identify the replacement property. Now, a safe harbor most experts accept of meeting this identifying deadline is entering into a sales contract or opening escrow. The second important deadline, 180 days. The property owner has 180 days from the closing of that first relinquished property to close and complete the acquisition, aka the purchase of the replacement property. This is an extra time, people. That 180-day deadline is concurrent with the 45-day deadline. Pat, are these dates that set in stone? Oh yeah, this bears repeating. Hitting those deadlines is crucial for qualifying as a Section 1031 exchange, which brings me to my next point. There are special escrow companies and title companies offering 1031 intermediary services. Please take care in choosing a competent one. An escrow company with experience in the Section 1031 exchange. There is simply too much writing on the proper paperwork and procedures being followed correctly for you to mess this up by being cheap. The replacement property should be valued more than your first relinquished property. Now, here's how the IRS keeps track of the deferred capital gain. Now remember, the Section 1031 exchange doesn't eliminate the capital gain tax, it simply defers it and delays when it needs to be paid. On your books, your tax worksheet for the property, if you will, the value of the old property carries over and becomes the on-the-book value for the new property. What does that do? By retaining the on-the-books value of the previous loan property, that capital gain is captured, like being stuck in tree sap. On the new property's tax worksheet, this number carries on until the new property is sold. It is in this manner that the IRS retains that capital gain generated on that first property sale, but the trigger for that capital gain won't come until when? That's right, when the new or replacement property is sold. Example, on Monday you sell your first property, which has a book value of $100,000. You take all the proceeds from that sale, and on Tuesday you roll all the proceeds to buying the second property, which was valued at $200,000. Now on Wednesday you sell the second property at $300,000, but this time you don't reinvest the proceeds. You just triggered the capital gain tax. But how much, you ask? By carrying over that first property's book value of $100,000, the gain from Monday's sale is now triggered too, which means the gain is, that's right, $200,000. $300,000 minus the $100,000, and not the $300,000 minus the $200,000 that you actually bought the second property for. Pat, can I roll over the 1031 exchange into another 1031 exchange and into yet another 1031 exchange? Yes, amigos, you can. Now let's play this out, people. Say you go your entire life incrementally accumulating larger real estate portfolio, all the while using that Section 1031 to kick that increasing capital tax bill down the road until you die. Pat, with the proper tax forethought and planning, could I theoretically bequeath to my beneficiaries, my loved ones that I leave behind, this entire Section 1031 portfolio as an inheritance and allow them to enjoy that step up in basis to the present day market value, thereby eliminating all that deferred capital gain I've been carrying around since the beginning? The answer, yes. Last word on this. Understand the term boot. Boot is just a fancy word for any money or personal property received out of a sale that was not immediately rolled back into the purchasing of that next property. Boot is income and will be taxable to you in the year that you receive it. This has been today's Caliente Topic. Thank you for watching. I look forward to seeing you soon. Take care.